Alphabet, Google, stock is up over 5.69% in the last month and over 39% YTD. Nevertheless, it still looks cheap based on historical metrics. That makes shorting out of the money, OTM, put options an attractive play for income traders. For example, analysts project that the company will make $5.34 per share this year, Google, and $6.27 next year. So, at today's price for Google stock today of $124.67, this puts it on a forward multiple of 23.3x for 2023, and 19.9x for 2024. Historical metrics. But these metrics are significantly lower than the stock's historical average. For example, Seeking Alpha reports that the stock's 5-year historical forward multiple is 26.26x. In addition, Morningstar reports that its 5-year mean forward P/E has been 25.19x. The average of these two is 25.7x. That means that Google stock is at least 19% or more undervalued. For example, the average of its 2023 and 2024 multiples is 21.6x earnings. So, dividing 25.7 by 21.6 is 1.19. This indicates that Google stock could rise another 19% before it reaches the average forward multiple from the past 5 years. As a result, we can set a price target for Google stock at $148.35 per share. This is derived by multiplying today's price of $124.67 by 1.19x. And remember that just gives the stock an average price/earnings multiple compared to its historical average. It would not be uncommon for the stock to overshoot this target, given its momentum lately. One way to play this, along with holding the stock long, is to short out of the money, OTM, put options. This allows the trader to both gain extra income and as well have the chance to buy in the stock automatically at a lower price should it fall. This is an easy way to average in one's cost over the long term. Shorting OTM Google stock puts for income. For example, the $119 strike price puts that expire on July 7 trade for just under $1 at 97 cents. That works out to an immediate yield of 0.815%, i.e., $0.97/$119.00. This is attractive since the strike price is 4.75% below today's price and the expiration period is just over 3 weeks away, 24 days. This means that a trader who secures $11,900 with a brokerage firm in cash and/or margin can enter an order to sell to open one put contract at $119. The account will immediately receive $97. That is why the yield is 0.815% since $97/$11,900 invested is 0.815%. If this can be repeated each month for 12 months, the annualized return is 9.78%. Note that more enterprising traders, who might be willing to take on more risk, can short the $120 strike price puts and receive $1.17. That works out to an immediate yield of almost 1%, i.e., $1.17/$120.00 equals 0.975%. But the strike price is only 4% away from today's price. That means that the trader might be forced to purchase Google stock with their $12,000 invested if the stock falls to $120 or lower on or before July 7. This could actually be a good bet since Alphabet's earnings and cash flow for Q2 won't be reported before July 7. The stock might not tank before those earnings come out unless there arises a deep fear in the market that the US economy is headed for a recession. So far, that does not appear likely. So, technically, this might be a risk well worth taking. Either way, this shows that traders can take advantage of Google stock's historically cheap status by shorting near-term OTM put options.